last but not least, YouTube live stream. YouTube live stream here. Let's see. Let's see. Live stream should be on, and we're good. It's live. Perfect. Okay, lovely. Happy Monday. First things first. Welcome in, guys. Hope you guys all had a good weekend, and we're back into another week of trading, another week of the market. Let me get a couple of things set up. Horizontal raise, we can delete these. Okay, let me see if there's any, because today, ideally, I do want to get some real live trading in. I feel like we've neglected this for a little bit too long. I don't see any new pair. Okay, S12K, welcome in, brother. Happy Monday to you. Okay, as usual, today we'll definitely try and get some live trading at the end. Even 10, 15, 20 minutes would be pretty ideal. But first things first, we'll go over some concepts. And simple market concepts. Yep. Main thing we discuss always, all of the time, pretty much, is understanding the trading narrative. And not from retail or, not from retail point of view, mainly from commercial perspectives. How do banks, especially banks, how do the big boys look at the market? And their perspective on the market provides a massive edge in, well, for us in trading, yeah? But, of course, now, we've discussed a lot in regards to this idea of correlation and why markets, in fact, the only thing we've not discussed is, for markets that is correlated, why are they correlated? I don't know if any of you guys... No sound. Can people hear me okay? Audio? Audio check. Audio check. Hello, 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 hello. Audio done. Can you hear me, yeah? Okay, S12K maybe... Okay, thank you, Joe. Ichiku, yes, I can hear you from here. Thank you, thank you. Okay, great. Now, S12K, maybe try reconnect, okay, brother? Okay, but one of the questions, of course, I think that's quite important, especially under this concept of correlation. When we're discussing correlation, when we're discussing internals, is mainly trying to understand, or at least the thought is, if the markets are correlated, first things first, what we've discussed a lot of the times is the reason why the market is correlated. Yeah, we've looked at it from different perspectives, of course. And really, to simplify it, there's two main reasons, isn't it? One is the market externals. In other words, is the big board, is the sentiment. If across the board, overall, the market is bullish, ideally we want to stay with that bullish bias. Not necessarily say buying momentum breakout trades, but buying on dips, on discounted markets. Yeah. So that sentiment, what we've noticed is it plays a massive key part in our directional, or for people who trade directional bias, for speculators, predominantly. Yeah. And the second main reason is, of course, supply and demand. Yeah, what we know as internals. What drives gold were also likely to drive silver. What drives NASDAQ were also likely to drive yes, or US 30, so on and so forth. So that internal market supply and demand is also very important. And this gives us the edge to look at the market from both external sentiment and internal supply and demand perspective. And of course, understanding that is very key, yeah, because understanding that is, of course, what led to US 30. If you guys, or if any of you guys were trading US 30 on last week, Thursday, or at least Wednesday, Thursday, we can see the massive, massive value that was hidden behind the green line, wasn't it? A little bit risky trade, I can't lie, especially Wednesday's market cash open. But what's worth pointing out, of course, is when we see trades like this, really, it is undoubtedly one of the best trades, most likely for the week. Yeah. To some extent, it can also be the best trade for perhaps for the month. Yeah, because you can see the way US 30 recorrected after what has happened, of course. Yeah. So it's obviously one reason why we want to take advantage of correlation to give us that direction bias. And not to mention, that's obviously US 30 coming into all-time high. Last week's high, oh sorry, not last week, consider this is last week, so week previous week's high. And there's a key decision to be made, of course, at that week high. And turns out the decision was rejection. Yeah, it was accumulation on a small time frame, but on a macro time frame, it will be a massive rejection, isn't it? On a daily time frame, it will be a candle up, candle down. Okay, so that'd be a massive pin on the top edge, and that explains the reasons to why, where the edges, or why commercials are trading this perspective. But it doesn't come to explain the reason why these markets firstly diverge in the first place. Yeah. So what we're trying to understand is, based on commercial activities, of course, we can see where commercials are looking at in terms of their trading narratives. Most likely in this scenario, they'll be buying, what type of trade they'll be doing? They'll be buying US 2000 and then selling US 30, no doubt, of course, here, because this massive divergence come in the background in terms of equities markets. So that spread, of course, offers a non-directional trade opportunity into the market from the commercial point of view. But the real question is, if I hide ES and NQ quickly and just leave these two lines on the chart, you can see phases where the two markets obviously parallel shift, and we can see phases where divergence start to creep in, yeah, into the latter half of this phase, where divergence started to happen. Green line making higher highs, well, the purple line do not make a new high. The new high has been capped, and since then has been making lower lows, lower highs. So you can see that change in structure, of course. But what we are, or what I'm going to ask you guys is, it's good seeing these things, but what is the reason causing this divergence? What do you guys think? Explaining this phase where the two markets are parallel shifting is pretty easy. Why? Because the market's bullish. Okay, the market's bullish. But in the bullish market environment, how can two market internals diverge off? Obviously, one reason could be news. Usually, news will be a driving or be a catalyst to either diverge the market or converge the market. But of course, with the US government shutdown, unfortunately, over the last week, there's not, CPI's cancelled as far as I'm aware. So there's not really a sense of news driving the market out of place. So if that's the case, I want you to guys have a quick think. Classy, welcome in. Is what causes the market to diverge, or how are commercials trading that's causing the market to diverge? From the point understanding that during this phase, most likely they will be buying the purple line and selling the green line. Okay. So what do you guys think? Any ideas to possibly why the market will start to diverge off, or what how does commercial trading activity looks like to explain this phenomenon or this situation that we are seeing, obviously, as part of the market truth? The doing spread traders, Monarch, yes, correct, but elaborate, yeah, elaborate. What do you guys think? What would you need to do on your trade for these two markets to start moving in different directions? What type of trading, or how would you trade to cause these two markets to start moving in different directions in the first place? Any ideas? Because this really opens the door to understanding the spread narratives. Because so far what we've mentioned is we're trying to not go on too complex in terms of commercial activities. So far what we understand simply is that when the market diverges, we understand that commercials are simply buying the lows, yeah? Which they do, of course. They accumulate the lows. And of course, on the other hand, they're accumulating the highs on this market, right? And the idea is when the green line drops and when the purple line rallies, or either or the green line drops a lot more than the purple line drops, either or, that spread makes profit, okay? But that's a very basic model of understanding this commercial spread trade. And of course, that's us predicting expecting what's likely to happen, because that will likely to be the pattern for commercials to close that spread trade off. But how do commercials firstly yield this spread, this spread widening? Not necessarily say they yield the widening, but how does the two correlated markets become uncorrelated, Or how does a correlation, what causes the correlation to break down, perhaps, is the better question. Phoenix says hedging. Okay. No. Okay. So often when we talk about spread trades, and I think maybe a long time ago we have briefly mentioned this as well, yeah? I just go here, yeah, Phoenix, welcome in, King. Gold Digger, welcome in. Commercial hedging both assets, absolutely. And one question is, now, we have mentioned this briefly, I doubt very much people might remember this. When commercials are opening spread trades, one side of the trade, they're using limit orders, and I'll do a quick reminder. So, when commercials are loading the trades on, to capture that perfect spread price, and of course what we talk about spread price is, if we put on, this is Russell against YM, yeah? And what we mentioned is during this phase, most likely they're selling the green line, they're selling YM and they're buying Russell as a narrative, as this narrative, okay? So what I want to put on a line here now is an additional line, and this is going to be the difference of YM minus RTY. And when I put this light on, of course, no, one thing is we have to adjust the ratio, otherwise it will look very, very close to YM, okay, very, very correlated to YM. But the ratio I'm not going to bother because I simply just want to demonstrate. Let me put this to no scale, because I simply just want to demonstrate the concept. Okay, a little bit too close, maybe not, yeah, maybe, okay, I'll hide this line. Okay, but I want to demonstrate this concept is when commercials are doing this spread trade, one side, of course, especially the side that they're absorbing, let's say, so that be the green line, because why? Because we can see the green line is printing into highs. When they're selling the green line using limit orders, they have to immediately buy the purple line using market orders to get that exact spread. And the timing is really key. The moment they get filled on the limits, they immediately smack the buy button, buy market order on the purple line. People might ask, but we mentioned this before, is that, but commercials use limit orders on the trades. Yes, they do, for the market that they're absorbing. Yeah, but as we all know, commercials also are spread traders. So to get that spread narrative, mainly the spread price, they need, which is this line. I'm going to hide Russell for a brief second. Yeah, and you may see this line is very close. Yes, that's because we're not playing around with the ratios, so it should be pretty close. In fact, it should be almost a perfect correlation to YM. Okay, because this whole narrative is this: is if this line here, and I'll take away Russell as well. If this red line based on our equation is YM minus Russell, so what we're looking at here essentially is if this red line goes up, RTY, if this red line goes up, for example, predominantly this phase, what we're seeing here is what is YM getting bought, isn't it? Or YM demand plus YM minus Russell. So if YM is getting bought, RTY must be getting sold, or is hitting supply, isn't it? RTY is supply, right? And this helps it pretty much explain why if this red line is bullish, and of course this is the spread line now, yeah? There's a spread difference between YM and Russell. So if this line is bullish, what we should expect the relationship between YM and Russell is that YM should be bullish during this phase. In other words, YM should be getting bought while Russell is getting sold, and that's causing this spread to start opening. Does that make sense? Then that's where we start to see that spread difference. Okay, so keeping everything very simple to understand. You know, many people think commercials are trading these two markets simultaneously, which they are, but they're not looking at those two markets to trade. They're mainly predominantly looking at this line. Well, of course, there's a ratio difference because it's not 1-to-1 ratio. Yeah, most likely RTY will be skewed maybe 1-to-2, 1-to-3, that type of idea, and that ratio will continuously change, of course, based on volatility as well. Yeah. So when we really discuss this concept, it's not something we can cover within 1 hour. It will take maybe a couple hours to kind of really understand, because this now dives into starting to understand the beginner fundamentals of bond trading. Okay, understanding the curve, and this is the spread curve. Okay, so without going into too much details, we're not playing with the ratios as we mentioned, and we're simply just trying to understand how this line can give us some ideas into what we should be doing into, let's say, YM and Russell. And of course we can do this with ES and NQ, etc, etc. Yeah. So this line, now many people say, okay, this line's great, so how do we use it, or what's the benefit of looking at this line? Well, first of all, this line is same as any other market. In fact, there's a spread market. Oh, sorry, it's a spread market. It's a spread trade in the equities market. So this line also has supply and demands. It will also follow market structures, such as things like extensions, right? Oh, what is this? Oh my God. 1 second, guys, bear with me. Actually, I prefer the one Monarch made. Market maker? No. Is it Monarch? Yes, I like this one. Okay, perfect. Okay, so this line will also follow things like market structure, where we will see profit taking come in the 1, and we'll see potential reversal come in the 2. Yeah. So there's no difference looking at this line simply as a market. It will have the same thing as market structure shifts, blah blah blah, etc, etc. So effectively, this line is being traded as a market, isn't it? Yeah. Because commercials are also looking at higher prices for a possible sell trade, because now this line is premium compared to perhaps another spread line, and that spread line could be ES against NQ. So now we've pretty much moved on a complexity from looking at simply just the market's correlation itself. Now we're really taking the next level look into the commercial spread. Okay, the commercial spread. Because right now we've only built one spread, yeah? And of course, once we start building all the spreads, now you start to get a spread narrative. And that spread narrative, because what we discussed so far is, based on this spread narrative, based on this red line, if this red line is bullish, let's say it breaks a structure here and it continues bullish, during this phase, all I would want to be doing is what, guys? Is buying YM and selling Russell. And if we are buying YM, of course, as we mentioned, this line is very correlated to YM, US 30. US 30 do result in a bullish scenario, while Russell into higher prices, what do we see? We see sense of absorption, we see sense of supply coming into higher prices of Russell small caps, isn't it? So that becomes a very interesting idea looking at this line to understand what we should be doing on the two markets from a spread trader's idea. And of course, this is exactly what commercials are doing. And as we already mentioned, why does this scenario happen? It's because during this phase, when commercials are buying this red line, or they're buying this spread line, they are buying YM using what, guys? Using market orders. So YM Momo trades, yeah? YM US 30 will become a momentum buy side trade. They will be constantly, not say they're not buying YM directly, yeah? It's when they see Russell being absorbed at higher prices, they will start buying YM using market orders. And if I do zoom in, especially this area where the spread really started, because if I zoom in, guys, this is where really the spread started to turn around, isn't it? Look. We see this sense of YM start to get absorbed into higher prices, right? Well, Russell start to continue climbing higher, isn't it? And that it starts to explain that narrative, and that narrative is explained through this red line. Yeah, this red line, this spread line, until that spread drops off. Once that spread drops off, we understand that now they will most likely do the exact opposite, and that is start to, let me put Russell on first, and that of course is start to buy Russell, and we start to see absorption happening into lower prices Russell. And of course, during this phase, YM should be going down more than Russell does. Yep. The green line should be traveling more than the purple line, isn't it? And we can see that phase where it overtook it here. Yeah, the green line started to lead the purple line. Okay, so the direction of this spread line is very important. The direction of this spread line is very important to understand which market, first of all, we should be trading, of course, when you build a spread like this. But of course, when we build a spread like this, I recommend to look at the ratio as well. And how do we find the ratio? not easily to explain. The easiest way is perhaps look at CME websites to look for the ratios themselves, okay? But the ratio is not really clear because why? Because the commercials, they don't share the ratio that they're trading this with, and the ratio adjusts so constantly that it's very difficult if you want to get a perfect ratio on these trades, okay? Because the ratio is mainly measured from volatility. A simple example would be if, for example, Russell is, or let's say ES and NQ, okay, this is maybe easier to understand. If ES is moving 10 points and the NASDAQ is moving 100 points, well, guess what? You would need a 1 to 10 ratio in that perspective. But it's not just as easy as a 1 to 10 ratio, is it? Because ES is $12.50 per tick. Well, NQ is $5. So then there's a 2.25 times difference. So you have to factor in the tick difference alongside the volatility to get us a close enough ratio, okay, if you want to. But again, like I mentioned, that's too much complexity. Just to simply understand one narrative. What we're trying to understand is, using this line or using this spread line, what we're trying to understand is, this now answers our question right at the beginning of the live stream, is two internally correlated markets. Why do parallel phases become divergent? Or how does a divergence occur? And the divergence occurs because the spread line, because of the direction of this spread line, okay? So this line obviously is very important for whichever market you're trading, yeah? And to understand this spread line and to have a good expectation. For example, right now, the red line is dropping back into support. So if the red line is dropping back into support, and this red line, if we expect the red line to go bullish from here, if it do go bullish, then of course we'll be looking to sell Russell at a higher price. If we get a higher price, and we'll be looking to buy YM at a lower price. And these two should flip around if I zoom in close enough, guys. Yeah, if I zoom in close enough, we should see the purple line sitting above the green line, shouldn't it? The purple line should start to sit above the green line. Okay, so that's the type of idea where we're looking to trade that spread, or simply a directional trade. Yeah, so that's the reason why that spread, when two markets are so correlated, why that spread occurs is because of the spread, is because of this green line here, the directional change in terms of this green line. Okay. Since Russell small cap is more volatile and sensitive to Dow Jones kind of uncertain situation, lack of government data due to shutdown. Indeed, that's why Russell may be more easily manipulated by big hands and things. Yes, absolutely. Russell is most likely the two markets, Russell and NQ, they're both very, very easily manipulated. Afternoon, Aston. Okay, so this idea obviously is very key to understand which market, and you can build this out for any market. You can do a similar one to ES and NQ, you can do a similar one to gold and silver. But as we mentioned, the ratio, of course, is very important. Otherwise, you would get a line that's very, very correlated to the markets that you put in the front end. No, yeah. But it's good enough to demonstrate a narrative. And oh my god, 1 second, guys. Let me task manager, because Telegram there's too much noise. Telegram. I'm going to turn Telegram off for the second. Where is it? Discord. Task manager. Well, I did not see it. Okay, I'll leave it for now. Okay, so that's obviously very important. Now, in terms of live trading, or in terms of right-hand edge trading, one thing we mentioned is, apart from value, one hour chart, let's go to 5 minute chart. Anyone trading gold today, I do think today, if not today, tomorrow will have a very, very, very strong move in terms of gold. Why do I think this, guys? It's because of this week's opening. Okay, last Friday, we can see this sense, and of course, number one is, when we're discussing volatility, volatility expands and then contracts, yeah? It will go through a cool down phase. First of all, it will go down a cool down phase, it will explode, and what we're seeing here, guys, look, in terms of volatility, we're trading inside Friday's US session high and US session low, isn't it? So we get a sense that it doesn't matter whether accumulation or distribution is happening here. We get a sense that volatility is being squeezed. Yeah. So if volatility is being squeezed, It's building up the momentum to explode again to one of the downsides, right? And this is where perhaps some of the traders who trade resistance, what's the word I'm looking for? Who trade trend lines, Jesus, who trade trend lines are able to somewhat be profitable, yeah, because they understand the simple idea of volatility. And of course, these guys are volatility traders, more accurately rather than trendline traders. Trendline highlights phases of volatility, volatility expanding and volatility squeezing. Okay, so you may say, okay, how does trendline traders trade? As you may guys know, it's a very easy concept. From the high, you pretty much mark it off, and from the low, you mark it off. From the high, you also squeeze it, and once it breaks out one direction, you wait for a pullback and you look to join in these type of ideas, right? That would be a trendline breakout trade, breakout retracement trade, that type of idea. And a similar thing that's happening here. Yeah. So if it does break out upside and when it retraces, it's time to jump in for the upside bounce. Okay. But of course, now which side does it break is obviously very important, and which side does it break, and is it correct? Of course, we have to link that into value. If silver right now is not really supporting higher prices in gold at the current moment, yeah, and in fact, silver is showing weakness of higher prices in gold. That's why gold is being sold off currently and is trading towards the lower demand. Okay, so if you're trading this type of trade, obviously analysis is very simple, yeah, and all you need is one line to make sure that silver, when you do take the breakout, silver's in line with your direction as well. That's obviously how trendline traders do trade, but it does highlight a great concept, and that is volatility, and that's what I do expect. If today US session do not break, obviously with US session, it will most likely, if it does not extend, it will range bound. It will take out Friday's session high, take out Friday's day low, and range bound. Yeah, it will be this type of scenario most likely. It'll do something like this. And then for the rest of the day, it will stagnate. Okay? If this type of scenario happens, tomorrow or even Asia session can be very interesting, can be very aggressive. Okay? Because then this is a whole day of accumulation. Accumulating for a whole day, that's a lot of orders being filled, being accumulated into low prices. So if it does break, that volume has to shift somewhere. And this is not a small bracket. Yeah. So if it does shift, it'll be $50, $54, $55, $50, 500 plus pips of range or potential, you could say, to either upside or the downside. Yeah. Okay, so that's why we need to be a little bit careful. Okay. Also, obviously, there's opportunities here. If we do see the breakout, it's good to jump onto that trade for a possible opportunity. Aston, what's your overall view on XAG? I was actually discussing with Monarch this morning. Let's quickly look over the market overview, and let's start doing some trading. Yeah. So from last week, I was also mentioned to Kwasi as well in the TTE group chat. Since last week, okay, if I highlight some of these links, I know there's a lot of links, and we'll mainly just look at the metals market, and then we'll go back into the metals market. So since last week, or towards the end of last week, we see, first of all, inflation started to recover, is what I've noticed, yeah, from the law print on Thursday. And if inflation started to recover, I started to think that, or I started to expect at least the higher prices of bond is going to be capped, and that should result in a change in sentiment, especially if inflation keeps rallying and recovering. Because over last week, especially on Wednesday, inflation really dropped into lower prices. Okay, and of course that leads to the question: is that low price drop correct? And of course we can also obviously answer that question, and the answer is still not correct, isn't it? Last week we also mentioned this because looking at RBOB and heating oil, we believe WTI into low prices is not as rightly priced, especially into bigger pivots. Yeah, so we do believe there is some sort of demand, or at least there should be demand for not necessarily a retracement all the way back up. Rejection all the way back up to the highs, but a retracement is definitely due from two angles. One is the price is overly extended. There's too much sellers, so profit takers will need to come in, especially into a low price. Number two is that the price, the value of WTI is not rightly priced. Into the low price is too cheap, it's too discounted from internal point of view. Therefore, we had the expectation that the green line is more likely than not will retrace, or at least for the time being will not move any lower. Okay, so After that, as we continue to watch the market, of course, into London session before US Open, bond market started to make the move into the sweep high, and of course started to make the move down. Yeah, and this, of course, really changes today, or not today, but the sentiment for the rest of the week. Because at the start of the week, we were pretty bullish. Okay, I was mentioning we were pretty bullish, especially on Wednesday's podcast. That's what I said. If inflation do not recover and drops, if it free falls, we are bullish the marketplace. Because if I remember correctly, at the time we were either going to be looking to sell equities, yeah, or sell gold at higher prices, or we're looking to buy euro dollar or cable at the time on Wednesday, depending solely on this inflation narrative. And if inflation drops, we are not selling. We're bullish. We're bullish on markets as cable. We're bullish on markets the yen. We're bullish on markets. We're bullish the forex markets, in other words. And we're just trying to find the market that is the most discounted. Okay, and it turns out, of course, yen was the most discounted out of the three. But there's no harm if it doesn't really matter which one you bought, because as it transpires, all of them had a pretty good result, going bullish as a swing trade from Wednesday to Thursday. Okay, so that's a good narrative overall. But the best way of the book, of course, would be yen, not buying dollar yen, selling dollar yen is a reverse negative correlation. Okay, so now today, inflation, or since week open today, inflation has not done too much. So far, what we can see is inflation has rallied a little bit, yeah, and now it's testing against Friday's day high, where a key decision has to be made. No surprise. Now we're leading to US session. It's coming into a key level. There's a key decision to be made. Well, everything makes sense, right? Everything stacks up. So again, expectation is very similar. Looking at these two markets right now, the green line and the bond, what we can see so far is that bond into low prices has met some sort of demand, has met some sort of support into low prices, into the day low so far, isn't it? Yeah, because inflation went much higher. So if we price it, if it should be rightly priced, bond should be trading where? Bond should be trading into the lows. The fact that it's not. Yeah. So if it's not trading into lows, and we do see a sense of rejection coming in, then we can first expect that bond has been bought. And is there any other evidence to suggest that bond price has been bought? Well, yeah, we can look at euro dollar, and euro dollar suggests that, well, not so much, right? So when we start looking at white line, the white line actually, well, if we zoom out, yes, but in a micro scale, we can see that the white line is currently lagging behind bond prices. Okay, so white line doesn't really give us a confidence that this demand is genuine. Most likely, perhaps profit taking. If it's profit taking, it's going to yield this type of move next, isn't it? Yield this type of move until we get true clarity of what WTI is likely to do in US cash open. Okay, so that's something to pay attention of immediately. But if we do zoom out, we can see that across the last few pivots, across the last week of data, bond prices predominantly is sitting discounted to dollar. There's no doubt on that. Yeah. So this is why it's very good to zoom in, to zoom out the charts. So we understand macro, on the macro time frame over the last couple of days, bond is very discounted, discounted. So there shouldn't be any surprise if we suddenly do see demand come into bond prices. But we understand the micro challenges of this current swing. This current swing might not move straight away. It might take some time. Okay. So when we become not as aggressive into this bullish narrative on bond because of this because of the macro discount, but micro premium. So there's a conflict between the macro, between multi-time frame analysis, isn't it? Yeah, there's a small conflict here. So we have to ideally wait for both things to align to take advantage of that. But with that all being said, if oil prices right now, that's testing this high, and of course this adjacent high on bond is this adjacent low if we market pivot to pivot, somewhere around like this, yeah? And we can see currently right now it's somewhat fair valued, and of course if you want to see that, because this is the highest high it's made and this is the lowest low bond is made, isn't it, until it dropped off, and obviously this would be a great buying opportunity for bond, because since then oil has not made a high, bond has made a low, yeah? So that's a great buying opportunity. But even right now, if we do pivot to pivots, we can see the two lines. Bond still has a little bit upside to go, isn't it? But now, would you argue this is something that's worth trading? In my opinion, not really, because the correlation is pretty much, you have to really zoom in to see the correlation. That's not on a candle-to-candle basis. The correlation, the divergence is not big enough for us to take advantage of that. Okay, so now into the US session, if I quickly look at oil's market, what we quickly notice is that oil testing this high, which we just mentioned here, oil testing this high, and of course, first of all, is we can see this key level. And the answer we're trying to find is this key level into this key level on WTI, is it likely to break? Is it likely to reject? Well, that answer comes from here, doesn't it? If we simply look at, let me hide the green line for a second. If we simply look at a position of the WTI now retesting this higher price, well, RBOB and heating oil are diverging off this higher price. Is it fair to say that this higher price most likely is going to reject? Yeah. So it's quite fair to make that assumption, right? Or at least have that expectation into that retested high. I think WTI is going to reject based on the internal premium that is offered currently by RBOB and heating oil. So if that's the case, it helps us to answer that key question, isn't it? Help us to answer that key question on the green line. So if the green line does drop off, does retrace, then we do expect bond to really make that recovery. Obviously, it depends on how much the green line drops off. Yeah, we expect bond to make the recovery. If bond do make the recovery in the macro time frame, again, no surprise, FX markets will become a good buy-side trade. The sentiment will start turning bullish. And that's not to mention cables already being bought since London, or prior to London this morning. Cables already being bought, and the only market that's currently lagging behind seems to be the red line, which is dollar yen. Very small divergence. In fact, there's a candle divergence on the 5-minute chart. But seems like a good trade, isn't it? Into that retested low. Dollars already moved up, euro dollars moved up, and that left dollar yen pretty much alone into the bottom price. And of course, that's a great buy-side opportunity, buy-side scalp for trade. Yeah. So if oil do drop off, again, I'm bullish the sentiment, I'm bullish the market. And if I'm bullish the market, this is actually not a trade I'm looking at. Gold will become the key trade of today if the market sentiment does shift to the upside. Gold is going to be due for a retracement or a correction on that on that lower price. Yeah. So that's why I want to highlight gold. So that's pretty much the market narratives. Is there any questions? And then we'll move on to trading gold. We'll move on to discussing footprints. I'm waiting on sales once it comes to create a double top. Oh yeah, sorry Aston, what's your view on the XAG? Similar to gold, no difference, still bullish, yeah? I'm just trying to see which one moves first. Okay, that's the only thing. Because the trade might not be on gold, gold might move first. Yeah, and the XAG might sweep. So if gold moves first, and copper, the trade may even be on copper. Currently, as it speaks, it seems like the trade's on copper. Yeah, because copper's now testing yesterday's. Sorry, not yesterday. Not yesterday. Friday's low. Okay, so far it seems like it's on copper. In fact, gold is the less likely trade that I'm looking to buy. Either it's going to be silver, either it's going to be copper. So far as it speaks, currently it's most likely copper because of that low price placement, positioning. Okay, so my view, asking for your answer, is bullish. Or on the whole metals market is bullish. But that's only assuming this narrative falls through, guys. This narrative falls through. Okay, because there's the opposite narrative. This is why we need to watch cash open very closely. If oil rallies, guess what? I'll be selling. That's not necessarily breakout trades. I don't want to sell breakout trades. The only market that I'll be looking to sell, perhaps, is the blue line. Equities. Okay. Or cable. Cable will be also very good. Yeah, we can see the cable's positioning across the markets. The blue line maybe not as good. Cable looks pretty good. Okay, but sell trade today. If the sentiment do go bearish, do need some patience, guys. Okay, wait for a higher price. Wait for a better price to sell into. Try not to sell breakout trades. Okay. Okay. With that all being said, now on gold, let's do some trading and let's do some order flow understanding as well. Let me take everything away and let me put order flow on. Let's go to our usual 1-minute charts. I'm also stuck in the range as we speak. Yeah, everyone's waiting for the 10-minute cash open. And CME data is showing to CME data. Oh, you're looking at a cold put. Yeah. These strike points, who shared this? The Gold Digger FX. Yeah. Maybe not today because we don't have time. But what Gold Digger showed here, the call put ratio, you can say ratio, but mainly the strike points is Kayla's defendance level, and these are obviously key levels as well. which we will discuss, of course, and there's an indicator which you guys may have seen I do use for trading indices, the volatility flex. The symbol is VIX for SP500 or yes, and the symbol is VXN for NASDAQ, and that should highlight out the strike levels, the strike points, okay, or very close, should be very close. Okay, so give TradingView benefit of the doubt. I doubt it's going to be very accurate to the tick, but it's accurate enough to highlight some of the key volatility points that dealers are defending. Okay, so this is a very good concept, but we don't have time today. Okay, nevertheless, let's move on gold. Let's go to 1 minute chart. And oh god, not done paper trading in a very long time. When was the last trade we done with 5th? Oh Jesus, so what, 2 weeks we've not done any trading. Okay, it's time to break that plateau. Let's do this. So now, in terms of order flow trading, there's no different, guys. So don't just, okay, I may be forcing some trades in to show some examples, okay? So the trades, quality-wise, may not be great because I'm trying to chase a little bit of quantity here because we don't really have too much time. But in terms of order flow, what we're looking for is, as locals, as scalpers, we're simply paying the most attention to these two things: the last pivot low and the last pivot high. And the reason as to why is, why we're looking so much at the last pivot low and the last pivot high. We're not looking directly into, let's say, what has happened over the last hour, because I think is in the commercials, in the not commercials, sorry, in the olden days on the pit, we know the retails, and when the retails come in to the pit and they look at the big board, and what will happen is there's no charts, obviously. Yeah, the market makers are shouting out the prices, okay? And of course, for example, right now, it'd be 69.2 offered, 68.6 offered, the price drops, 68 evens offered, 67, 68 evens bid, 68.3 bid, and that's how the prices are, and that's how trading is done in olden days. Of course, obviously no charts, no candles, nothing, okay? So once the high is created, for example, here 75.6 offered, and since then the price have not been above the 75.6. What the locals, what the retails used to do in the olden days is to have a pen and paper, obviously, and they'll write down 75.6. So they write down that fractal, that pivot on the sell side. And if they're buying, guess what? That 75.6 becomes their target. Yeah, and once a new low is created, if they're selling, that becomes a target. Or if they're looking for a buy trade, they will wait until 60.8 that price is being offered. They will maybe go 60.8 bid, and they'll start raising their hands and try to get that bid price. So that last pivot high, last pivot low is the most important to scalpers, to short time frame traders. Yeah, because that's the most recent supply and demand. The more you start to look back, you start to incorporate the concept indicators where you start to endure more lag. Because the question is, the buyer or the seller who sold here, what's the likelihood of they're going to sell again? Isn't it? You start to need to find out these type of answers, and these type of answers, of course, can be answered from value. Okay, I just see that the value is very bad for this trade. Okay, so we took a buy trade, first of all, and based on order flow, well, first of all, based on structure, this is a high, this is a low, as we just discussed. Based on the structure, is a good level to buy? In my opinion, yes. Why? Because of the 0.5. That's why we do see some buyers coming in. But what's the issue? The issue is when I turn on this chart, it looks horrible, isn't it? Silver does not show support at that mid price. And this is where a lot of traders, trade ICT, they say, okay, but this is a fair value gap trade. Why did this fair value gap trade not work? Well, sorry to tell you, because there was no value supporting this fair value gap trade. So it's a little bit unfortunate. You don't take every fair value gap trade. Okay? May not get traded here. Why did I decide to trade in here? Because I can see silver is now hitting into demand. So if silver do go bid, that's going to put internal demand into gold, and it's going to go drive gold buyers into higher prices. Which, if I did get filled, I'll be looking to get this initial entry out and hold this buy trade at the lower prices, yeah? Because this buy trade is very bad based on what has happened to silver, based on what we just saw. Okay, so in terms of order flow, the last pivot high and the last pivot low and the 50% halfback is very, very key. And of course, we understand value. We're going to keep everything simple. We're going to keep one value line, and the rest we're going to really, really emphasize on order flow. And in terms of order flow read, there's a couple of things we need to pay attention to. Mainly the deltas, because we can see the level 2 liquidity book, which is it important? Yes, it's very important. But we can see it, so there's no too much point going over it in too much detail. But what I'm referring to essentially is people who have traded. It's the DOM. Yeah, it's a DOM. Okay, this is what I'm referring to as a level 2. And of course, you should see if it's 3-1, likely the price will go higher. 1-to-1 is adjusted. 3-3, the bid and spread widens. 1-to-1, again, it's balanced. 1-to-1, balanced. So that's the type of idea, but obviously this is within 2 ticks or 1 tick of price. Ideally, you want to see within a couple ticks out of the price to get a good understanding of what is the market maker doing. In other words, yeah, what is the market maker doing during this or during any phase? Okay, but currently, if we're watching just the deltas, we're always going to be a little bit late to the party. What do I mean is, for example, I wanted to buy this green candle, yeah, but I wanted to buy this green candle at this price, not at a higher price. Values dropped, but lack of sellers coming in. So most likely they were trying to go for the sweep, possible sweep, liquidity sweep, until they, well, unless they manage to get sellers coming. But currently right now we see 12 against 18, buy side imbalance, 5 against 3, sellers exhaustion into the bottom 2 ticks. So market makers were likely to start withdrawing the offers to let that sell side, to let that sellers coming in. Yeah. They will start to withdraw the offers, or they should, to see if sellers are willing to come in. See, by them withdrawing the offers, sellers are coming in, isn't it? 11, 10, okay, trading view really sucks at this. So let's see, still not enough. Let's see if they'll rotate the buyers out. Because during this phase, look at the candle, it's 23 deltas, 23 buying deltas, but the candle closed red. So that's a withdrawal liquidity, isn't it? Withdrawal of liquidity, and there's now sellers coming in. 15, 5, and that's a seller what we're looking for. Now, is that a lot? Not really. Not really a lot of sellers, to be perfectly honest. But during this phase, it's better than this candle, for sure. Yeah. Let's see if we can get fill at this price. But overall value is not the best. I have to be honest. The value is really, really not the best. Because right now, first of all, we should take this trade here. But nevertheless, since we're in a trade, we're trying to discuss how we can manage a trade out in the next 5 minutes or so before cash open. Yeah. And we explained the reason why we shouldn't be taking this trade, because silver's dropping. Silver, in fact, suggests that gold should be trading all the way down to this pivot low. Listen, silver is sitting at this pivot low currently. So that suggests gold should also be trading towards this level, around the 60s. Around the 60s. And of course, gold is trading 67s. So we have a $7 premium. So we're actually buying something that's expensive, which is not good, is it? We don't buy expensive things. We sell expensive things. Okay? But nevertheless, we're into this trade, and we're trying to see how the order flow behaves, and we're trying to see if gold can be the driver or can be the leader. Okay? And currently what we see is we did see seller get trapped, and of course now that entry was really good. Yeah, we see the seller get trapped, and we see the buyers coming in straight away above us, 0.15, great news. Now, sellers immediately pushed in 36.9. But based on what we see right now, this is still good news. Why? Because market makers are also rotating the trade bullish. Yeah. Why? Guys, 36.9. Look at net delta, minus 27, and the candle is bullish. That means market makers must be rotating the trade bullish. Listen, they must be withdrawing offers on the upside. So we do expect a bullish continuation coming in until we do see a buyer that's getting jammed at higher prices. So currently it seems like buyers exhausting, which is not too good news. Why is buyer exhausting? Because of this in the background, silver not supporting higher prices. If silver is not supporting higher prices, there will be lack of demand at higher prices, and that will result in what we see there in terms of order flow. 3, 5. We had 15, 9, 11. Where's the buyers here? Into the 67.3s level. Buyers vanished, isn't it? Buyers are no longer keen to pay that higher price onto gold due to this current value. So puts us into a little bit of trouble. But let's say 28, still not buyers, right? Still no buyers, which is obviously not good. At this point, ideally, if we can, close out the trade, because the trade is not that great. We're trying to see if buyers can catch this. If buyers can catch this, at least we can get this trade off. But seems unlucky. Yeah, it seems a little bit unlucky because value, silver is tilting up, pointing down. Yeah, tilting up, pointing down. So if this candle do not take out, then most likely we're going to go for the sweep low. It's a foreign language and turns to some of us. We'll go over this, don't worry guys. Yep. Yeah, I appreciate sharing the data. Of course, this is very key data for trading indices. For what I can see, XAG on H4 has retested key levels, so looking for sales. Yeah, indeed. It does depend a little bit on sentiment. Okay, so sellers are coming in higher prices, value is still not supporting, so this is not looking too good. I'm trying to say because there are sellers coming in, so if they do sweep the higher price, we still may be able to get out. Yeah, and here comes the higher price sweep. Nice, perfect. Perfect, perfect, perfect. And that gets us out of trouble because 15 buyers coming in, now we start to see buyers start to commit too aggressively against a value that is not supported into the last pivot seller, into this last pivot seller. So buyers might start to struggle here a little bit. Yeah, we will see the market makers start to try and rotate the price down into this higher price. Okay, especially if buyers too overly commit into higher prices. Okay, yeah. I'm literally contemplating on closing this nonsense. Phoenix. Yeah, I'm so sorry. The thing is, Phoenix, though, because what we mentioned is the exact same that's happening on Euro Yen right now that Phoenix is sharing. Is the volatility condensing Phoenix, yeah? But obviously we're ahead of cash open. Do need to be a little bit careful because they might sweep, they might play games in the cash open. Since you're already in the trade, tough decision. Obviously, I'm not going to lie, it's a very tough decision. But I will try and see. Yeah, so as expected, the higher price is not supported, isn't it? Yeah. So that's what we expected as well, because value does not really suggest a higher price. As we can see, value silver-wise is definitely sloping low. And if silver's closing lower, that shows that gold at that close should really be here, isn't it, as a parallel line. But instead, because these sellers came in, 17.24, 16, these sellers came in, that gave us the entry, and that's what we're looking for. Yeah, that's what I was looking for. A little stop hunt against these sellers that would get us out of the bad situation. And of course, stop loss to break even. And what's likely to happen next? Most likely will be a rejection. And now with cash open, just open, the volume is going to start flooding into the market. Yeah, but you can see right now, still, with that all being said, the trade is still not on gold. The trade is on silver. Silver into the liquidity low. Yeah, gold is driving silver into the higher price. We can quite clearly see that. Okay, so if anything into this US session, overall, in summary, I am predominantly bullish. But predominantly not really bullish on gold. Most likely silver or copper, these are the two markets that I'm looking at. And copper, as we also mentioned at the start of the podcast, is the better buy trade here. Yeah? It's the better buy trade. In terms of pricing, in terms of positioning, is the better trade. Okay, I'm not saying it's a better trade, it's safer. Well, better trade is safer, but also has the most profit potential as well. Okay. Because let's say if all the markets rally back up to here, gold is currently already here. So gold will rally to here, and silver, obviously, will catch up a little bit more to rally here. And copper, sitting at low prices, will catch up a lot more, isn't it? It has to catch up a lot more. So out of these three lines, we can see which line's the longest. Obviously, it has to be copper. That will make the most profit. If they all converge back up to the same point when that spread closes. Okay, guys? Any questions? Okay, Phoenix, I will still hold this trade and see if you can get, not say lucky, but if it does run bullish, of course you'll be in this trade for good because I do see Euro can strengthen. Yeah. Now with inflation now is driving lower, I can see that Euro can strengthen. Okay. Now with inflation trading lower. Indices are cash open so far, nothing much as it seems. There's no sense of spread opening, is there? No sense of that spread opening on the micro time frame. On the macro, you could argue, yes, US 30 looks pretty good, but I would be a little bit concerned because all the markets are moving aggressively bearish. And if anything, I do see NASDAQ popping its head bullish on the current time. Yeah. NASDAQ a little bit aggressive, a little bit too aggressively bullish. Okay, so maybe possible sell scalp opportunities into the cash open. But personally, I don't want to sell. My bias is still relatively bullish. So if anything, I would like to stay on the buy side. Here you can see US 30 rejection coming in, Russell rejection coming in, NASDAQ going bullish, yes, going bullish. So most likely right now, Russell small cap seems like where the buy trade should be at. Yep. On a scalping perspective, because across the book, the green line has a better discount. The green line has a better discount. Okay, makes sense. Structure shift from 1 hour 50 minutes. Yep, confirmation on open candle as well. Yep. Dollar is getting strong. I got my confirmation to hide to hold July VPS. Yes, indeed. Best of luck. Best of luck, Phoenix. And best of luck to everyone as well. For the cash open ahead, I will stop here so you guys can start focusing on the charts for the trade. Yep. Okay. On that note, guys, it has been a pleasure, of course. Good to be back. And this week, predominantly with one more live stream, we will mainly just focus on live trading. I want to get as many examples in as possible on Wednesday. And for people who are interested enough, because we've discussed a lot about value, to be perfectly honest. And hopefully at this stage, we have a good understanding about value, because I do want to discuss a few complex points like today. Today's more introduction, but from next week onwards, we will start to dive into a lot more complexity based on or beyond the current market correlation. We will start to really dive into this idea of spread and understanding the curves, the curve narrative. Okay, but guys, yeah, live trading will be on Wednesday, and then we'll continue. Thank you everyone. Thank you, Mark. I appreciate it. I appreciate you guys. Muzan, thank you for joining. Phoenix, Monarch, take care. All the best for now. That's me from Globalex. All the best. Ciao, ciao for now, guys. Bye bye.